Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion, and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Nick W., Jackie A., and Jim S. Matt Geiger is our guest today. Matt is founder and managing partner of MJG Capital Fund, a San Francisco-based natural resource-focused capital group looking at the junior end of the natural resource business. You can learn more about their work at mjgcapital.com. Matt, welcome to the show.
Great to be here, Andrew. First time for me, but I am a listener. You have some high quality guests on your program and ask some good questions. So I'm pleased to be joining you. Thanks for having me.
Well, I appreciate that, Matt. Appreciate the feedback there. And we certainly try to, if we're too tough with our questions, we found that some guests just don't come back. But hopefully we can try to find a middle ground there to kind of keep the guest list and also get a little bit more information than what other people are getting out there. Well, let's, for the audience who might not know you and your work, can you give us a background and then tell us why you started MJG Capital to focus specifically on the natural resource sector?
Absolutely. So I'm a younger guy. I'm just in my late 20s, so that's a bit of an anomaly in this older industry. As you mentioned, I manage an investment partnership based out of San Francisco. It has a full resource focus. We'll hold between 15 to 20 positions at any given time. So it's a nice concentrated portfolio. About 85% of the portfolio right now is focused on the junior end of the market. And then the remaining, 15 to 20% is in resource investments that fit our mandate, but aren't necessarily correlated to the junior mining cycle. So that could be agriculture, that could be aquaculture, that could be forestry, that could be water-focused investments or what have you. But as of now, we are very much exposed to the junior space. I take a bottom-up approach to stock selection for the fund. So for me, it has much more to do with management team, the quality of the asset, looking at spot metal prices, the company's financial structure, upcoming catalysts for the company's price to value metrics. Only then do I actually look at the jurisdiction and commodity. So those are the things that are very lowest on kind of my investment checklist. I of course have specific opinions and biases for some metals over others, but for me, I'd much rather invest in a high quality management team at a decent valuation of a metal I'm not too excited about than to be involved with the latest and greatest flavor of the month, which inevitably will fade. So that's kind of how we select investments. Roughly half of them are initiated through the open market, so through open market purchases, and we're also quite active with private placements. Generally, if there's a company, even if it checks all the other boxes, great people, great asset, upcoming catalysts, what have you. If I know the company needs to raise money in the next, 3, 6, 9 months even, I'd rather just sit on my hands and wait for the placement and potentially get warrants and or a discount to market when that occurs. In terms of what initially drew me to the resource space and into mining in particular, I launched the MJG fund in college, which in hindsight was maybe a bit of a mistake. I definitely launched it a few years too early. I think that just speaks a bit to my entrepreneurial personality, which can cut both ways. That's both a blessing and a curse to kind of want to jump into things right off the bat. We launched the fund in late 2011. So needless to say, we immediately faced 3 years of pretty immense pain. Fortunately, the fund's partners have all agreed to a 10-year lockup. We're an open-ended fund, so we've taken partners as recently as last month. But all partners are locked in from 10 years from their very first investment. So we only accept, very, very patient risk capital, and it's self-selecting in that respect. And, due to the structure, we were able to survive what was a very painful, very deep and drawn out, 2011 through end of 2015 bear market. But kind of stepping, one step back, what initially drew me to the space I've done a lot of thinking about this. I don't think there's a very, clean, one sentence answer for you. I don't have any family connections to the space. I think a great grandfather of mine who hailed from Portugal, worked in the Chilean copper mines, back in the early 1900s. That's about as close as I get to the space in terms of immediate family. Kind of the three things though that I've kind of summed it down to of what attracted me originally. First, it's just basic demographics and ecology. I'm a big believer in the resource depletion thesis. I don't think there's going to be a global apocalypse and we're going to run out of oil tomorrow. But by the same token, over the course of my lifetime, over the next 60 to 70 years, I think humanity is going to confront the realities of our exponentially growing global population, coupled with exponentially growing consumption on a per person basis in a globe where there's a finite amount of natural resources, metals, water, agriculture, production capability, et cetera. So that to me has always made intuitive sense. And I think society and humanity at large are kind of glossing over the fact that you just can't continue to grow exponentially when there's finite resources. So big believer in that. Kind of the second thing that I think drew me to the space is the generational gap, to be perfectly honest. I'm a contrarian, by nature. I know there are some really sharp younger guys in this industry. They're few and far between, but they're out there. But a lot of them are, up in Canada or Vancouver, New York, even places with more of a natural resource presence. To me, I was the only person in the entire San Francisco Bay Area interested in resources. At least it felt like that, and certainly the only one under 50 that was interested in it. So to me, that was more of an opportunity than a negative. Again, as I said, I'm a contrarian by nature, and for me, I know this industry is going to be just as relevant as it is today, 60 to 70 years from now, if not more relevant as I'm older. And so I feel there's kind of a massive generational gap and an opportunity for younger enterprising men and women to get involved, build a reputation, learn through experience, and kind of become the industry leaders in the 20 to 30 years from today. So taking the very long-term view there. And then finally, sorry about this long-winded answer, kind of the third factor I think that attracted me to this space is kind of the psychology of it. I mean, there is no industry out there, with the possible exception of shipping, but there is really no industry out there that's more volatile or more cyclical than the natural resource space, and particularly the junior mining space. And so for me, your average investor out there views cyclicality and volatility as negatives and as things to avoid. From my perspective as a value investor, if you have the right temperament and the right personality, and I think I do have a bit more stomach for risk, a bit more stomach for volatility than most people out there, I think you can redefine your relationship with volatility and with cyclicality and turn it to your advantage. And so for me, if anything, these factors that are inherent with the industry are features and not bugs. And so for a lot of the reasons people stay away from the junior mining or the mining space in general, it attracted me because I feel that I have a better psychological tolerance for the ups and downs and the big swings that we see in either direction. So that's kind of my long-winded explanation of what drew me to the space initially.
Appreciate the summary and the introduction there, Matt. I think that you're absolutely right in a lot of the things you bring up, with the exception of that I don't understand why you still are in San Francisco, but we'll leave that for another discussion.
I can answer that very quickly. I mean, to be honest, I think there is an incredible amount of hypocrisy in Silicon Valley. And it really frustrates me that the very investors that are, putting money into the newest Teslas and the newest battery technology and the newest renewable energy, the part of the world that's driving innovation just fails to see the significance of metals going into what's being created. None of the stuff being created in Silicon Valley would be possible without the metals that are pulled out of the ground. And so there's a pretty big disconnect there that I'm hoping over time I can help bridge. Because there are some, there's a lot of negative perceptions about San Francisco and the Bay Area. One thing I would say is that there is a risk-taking appetite here. And there's also a lot of capital sloshing around, as you could imagine, given that we're 15, 16 years into a tech bull market. And so I think there's the capacity for Silicon Valley kind of VC-like investors to become enmeshed in the junior mining scene and to kind of transfer some capital from tech into mining. Certainly hasn't happened yet. But that's, I think there's the potential and the opportunity there. And then just for me personally, there's very little competition in terms of other asset managers in the same area. So for me, I stick out like a sore thumb, and I like that.
Certainly, California is an attractive area. I one day hope that the state politics and the regime there will clean up their act a bit, but nonetheless, it's certainly a notable place to be, and there's certainly no shortage of capital in that area.
Cost of living is pretty insane here.
Yes.
Just given where we are in the cycle, I'm living like a Spartan right now. I'm living as frugally as I can. Maybe in 5 or 6 years, investors that are in right now can ball out and start living the high life. But for now, I have, the vast majority of my net worth squirreled away into the MJG fund, because I think we have some, 3 to 5 years ahead where fortunes can be made.
Yes, and the sector certainly provides a interesting profile, as you said, cyclicality, in some degrees predictability as well, where you might not have that in some other areas. And so I think that there's some good opportunities before us, and of course we over here are quite focused on it as well. Can you share a little bit more about the structure there at MJG? Can you speak to maybe the fund size, what the house rules are, as far as, I know you spoke a few of those house rules as far as fees, and then also maybe speak to the performance over the last couple of years?
Certainly. So I won't give you an exact figure on the size. I can say we're sub 10 million in terms of assets under management. So we're a smaller fund. It's tough for a younger guy of my age to raise capital, and even more difficult when you put a 10-year lockup on all new money coming in. Of course, that's a conscious decision that I made. There's plenty of investors that would have put money in, and we could maybe have 60 to 70 partners, or 2 to 3x the amount if I'd had less onerous restrictions. But I really wanted to set the fund up for success, long-term success, and I think I'm happy with the decision there. Fees are quite low, even though it's structured, like a hedge fund. It's the LP LLC setup, where each new investor becomes a limited partner in the fund and has to be an accredited investor. I don't charge the onerous 2 and 20 management fee that you'll see with a lot of hedge funds. I just go with a simple 1.5% management fee and no performance fee, or no carry, as it's sometimes called. Some people say, well, you're not aligned as an investor. What's your incentive to make money? It's like, well, firstly, especially some of the very earliest investors, there's a lot of friends and family in this fund. So I have an incredible incentive to make these people money who have put trust in me from the very beginning. Secondly, at this point, I own 25% of the partnership personally. So I'm very much invested and very much incentivized to make this work in a big way. Like I mentioned, we started in late 2011, I think, with around 9 original partners, and we've since grown to just below 30, with money coming in, on a monthly basis at this point. The fund is starting to gain some good momentum. That really started in early 2016, where I think the long and drawn out bear market of 2011 through 2015 finally ended. There's been some rocky years in between now and then. Last year, 2018 in particular comes to mind. But on an absolute and relative basis, we're looking really good over the past 5 years. I don't want to go into specific long-term kind of performance metrics. I can say that this year we've had quite a strong year. Even though half of the portfolio is exposed to base and energy metals, the precious metals, or gold and silver investments, have really carried the day. As of mid 2019, we were up 42%, I believe, over the trailing 6 months. and I'll be reporting our final year-end results in early January. I send out an investor letter to all of the fund's LPs, as well as people that are following the partnership generally. And I expect our returns to be kind of in that 40 to 50% range for 2019. So that's positive, and I think will result in further inflows. So yeah, that's kind of the immediate performance metrics. I think through mid-year of this year, we were maybe up 120% over the trailing 3 years. So that gives kind of some perspective that over the short and medium term, we've done quite well. But my hope here is that for the next 3 to 5 years, most of the gains have yet to be made.
Well, let's talk uranium, precious metals, and base metals. But first, can you just give me briefly your thoughts on the broad market at this point and going into 2020?
Sure. Well, I'm not a macroeconomist. Obviously, I try to follow the general economic picture and do have my own opinions. I mean, personally, I think this recovery is extremely long in the tooth, and we're what, in the 11th or 12th year of really an unabated recovery since the great financial crisis. It's been largely driven by both fiscal and monetary stimulus. So I think it's somewhat artificial. I've thought for a few years now that we're quite long in the teeth and that the end is near. I've now come to the conclusion that at the very least, the central banks are going to be able to push off a recession, or more specifically a stock market decline, at least through the upcoming U.S. presidential election in November of 2020. So at least over the next 9 to 12 months, I don't think we're going to see a global blow up. I don't think we're going to see that 2008 black swan, liquidity crisis that many people have been anticipating for years. I'm obviously very cautious on the U.S. stock market in particular. I think a lot of asset classes are completely priced for perfection, particularly in the U.S. I think globally, there could be some value in emerging markets. I'm a bottom-up investor, as I mentioned earlier, so I think through individual stock selection, no matter what market you're buying in, there can be money to be made. But in terms of for friends and family and people asking for my advice, I mean, I would limit exposure to the major U.S. indices as much as you possibly can, because I think they are priced for perfection. But I don't necessarily think there's an imminent decline coming in the next few months. If anything, we could see a little bit of a recovery going into next year. I don't think it's going to be particularly strong or exciting. But we just saw the job numbers come out earlier this week that surprised to the upside in the United States. You've seen indications that stimulus measures in China, seem to be working at least to some degree. I saw a couple days ago there was a good Reuters article talking about how China's crude oil imports are up 10.5% year to date when compared to the same period in 2018. Their coal imports are up 10.2% year to date when compared to the same period last year. And their copper ore and concentrate imports are up around 8.5% when compared to the first 11 months of 2018. So, that's positive from at least a raw material demand perspective, and maybe speaks to the state of the global economy. We may not be quite near the end yet.
And Matt, as we go through this transition period with the election in the U.S. coming up next year and so forth, and as you mentioned, long in the tooth, what's your thought on where we are in the natural resource sector when you go back and you look at, say, a 2008 type setup where everything came down versus maybe a 2001 type setup where the big market had risen and was in decline, but natural resources inversely reacted to the broad market? What do you see going forward? How do you see this really playing out as natural resources get going?
That's a great question. I mean, and there's a big distinction between the 2001 period and 2008 period. You're probably well aware of this. In 2008, commodities, metals, agricultural products, just basic materials across the board, had just gone through a 6 to 7 year bull market. So when that major, broader market correction came, those two were priced for perfection, and the pain was substantial. 2000, 2001 is a bit different because they'd already been beaten up for years and years and years. And so there wasn't all too many gains to be given up at that point. I'd like to think that, when we do see the next market meltdown, which is inevitable, again, it may not be for 5 years from now, but there will be another painful 2008-like crisis, and it's going to happen sooner rather than later. I think if you're invested in junior companies, you should understand that there are risk equities at the end of the day, and the chance for dramatic near-term capital losses are quite possible, even if it has nothing to do with the underlying fundamentals of the company. If we truly do go through a major risk-off, panic event, I think it would make sense for juniors to sell off. The degree for them to sell off, again, remains to be seen. I'd like to think that it would be more of a 2000, 2001 like scenario, where since they're not priced for perfection and in some ways are as cheap as they've been in decades, that any pain from an imminent market collapse would be somewhat muted, at least relative to what we saw in 2008. But I also don't, I don't think you should delude yourself as an investor, and you should bake in, at least a 30 to 40% drop in these, and even some of your better junior mining holdings, when we next see broader market turbulence. And I think you have to psychologically prepare for that, so that if/when that occurs, you don't panic and sell out at the bottom, assuming that the company's fundamentals haven't changed and that your investment thesis hasn't changed.
Certainly, and I think that's where cash comes into play quite heavily, making sure that you're prepared for some of that potential outcome versus some of the other potential outcome that we could potentially see, like a 2001 type scenario. So I think cash is really kind of the key to be, or cash equivalents, if you will. Well, let's move to uranium, Matt. Can you tell us how long you've been in the sector? What have you learned over your period in the sector? And what strategy are you employing for exposure going forward?
Well, we've had a very painful experience with uranium, really over the past, we'll say, 3.5 years. I think, we first bought uranium names is either in late 2015 or sometime during 2016. So it's certainly been a decent percentage of the portfolio for multiple years now. Fortunately, not too large of a percentage of the portfolio to weigh too heavily on our performance. So I think I've gotten that right to some degree. As recently as mid-year 2019, our uranium exposure on a weighted basis was, in the 13 to 14% range in terms of the total MJG portfolio. Now, as a combination between a couple sales we've made and just capital depreciation, it's closer to the 5 or 6% mark. So we still have a foothold in uranium names, but it's a bit weaker than it's been in years past. My hope is to beef that up closer to double digits over the coming few months. I remain a uranium bull, especially in the long term here. I think the narrative is brain dead simple. I think it has the potential to be grasped by millennials and by generalist investors and really everybody that are at least somewhat pragmatic. Nuclear being the only form of baseload power that can generate electricity around the clock 24/7 without any CO2 emissions. I think just politically, even if you're not a Greenpeace advocate or an environmentalist, I think the changes we're seeing in the emerging world and in places like China and India, where it's become a political necessity for the governments there to clean their airs and to reduce pollution. Again, not out of the goodness of their hearts, but purely in terms of maintaining political power. Pollution is a major issue. And so I think from a long-term demand perspective, we're going to continue to see reactor build out in the third world. I think in the United States, you can assume that the demand story is dead, at least for the medium term. But we've also had, 8 years now of supply destruction, and it took longer than most industries for uranium to rationalize. We only started to see the first supply cuts in the 2016 timeframe. So most companies hung in there for 5 years without altering their operating strategy. But we have seen supply curtailments around the world. We've seen funding for exploration and development dry up for all but the very most promising projects. So again, I mean, I think this is a coiled spring, and I think that when things do turn, the fact that it's taken so long for the next bull market to come in uranium will inevitably mean that when it does, it's going to be that much more powerful. So I remain optimistic, but it's obviously been a tough slog, and I'd be fooling myself and your audience to say that things haven't turned as quickly as I expected them to.
Certainly. And it's a good thing, too, to some degree, because you look at all the symptoms that you outlined, all fantastic for the types you and I here, fantastic opportunities for us to align our strategy and prepare and set ourselves up. And so to some degree, I continue to want to say that this has certainly been a blessing to have this kind of delay. And really, as you said, the longer this goes nowhere, the better I believe it'll also come out to be. So I think there's some really good stuff going on. Now, let me ask you this. Talk specifically about how many uranium stocks does MJG have in their portfolio? If you could just give us a count, what do you think is reasonable there? And what is the strategy? Do you guys look at all the different stages, your explore, produce, develop? What are you guys doing there as far as strategy and what you see as a prudent number of stocks?
Definitely. It's a good question. And I'll go back to the point, we are bottom-up investors at the end of the day. So while I do have a bullish kind of predisposition to uranium and a positive long-term view, you really need to look at it on a company-by-company basis. So I would never recommend any investor, no matter how excited you are about a certain commodity, to go out there and buy the 15 or 20 biggest names, or the 15 to 20 juniors that you see that are promoted the most. That's just a recipe for absolute disaster. And so again, the way I would look at it, if you're new to the space, would be to drop a list of all the uranium names. There are about maybe 40 companies out there, 50 companies between the ASX and the Canadian exchanges that claim to be uranium companies. Maybe a dozen of those, or up to 20, are decent. But anyway, pull together the full list, work through them one by one, and really just select the 2 to 3 that you're most comfortable with. And before you get excited about the given commodity, again, look at the management team. Have they made money for investors in the uranium space before? Do they operate honestly, and do they operate ethically? Do they have skin in the game? Do they own 1% of the company, between board and management, or is it closer to 15 or 20% of the company? That can make a world of difference. Assuming that they do own 15 to 20% of the company, where do they get in at? Is their share price, are they averaged in at 10 cents and the company's trading at $1.50? Have they already made 10x on their money? Or are they even or even below from where they put their money in? So all those things really, really matter to me as an investor. I think for these early stage ventures, people are key. Got to bet the jockey. It's cliche, but it's true. Then look at the asset. And I think it's foolish to be plugging in, any uranium price higher than $40 or $45 into your model. So I think in the case of uranium, it's okay plugging in a higher price than spot, just given how out of whack the supply-demand dynamics are. But I think just out of conservatism, if you're counting on $60, $70, $80 uranium to make your story work, then that's just foolhardy. That's too greedy. Well, why not invest in an asset that makes sense at $40 or $45 uranium? If the price overshoots when this next bull market does begin and we end up flying up to $70 or $80 per pound of uranium, then great. That's gravy on top. But I wouldn't get too greedy in terms of price assumptions when you're looking at the actual asset. Look at the company's financial structure. In particular, when do they have to raise next? How's their working capital look relative to what they're spending all in on a monthly basis? And what you'll find, especially in today's environment, that basically, I mentioned there may be 40 uranium names out there. Almost every single one of those companies are going to have to raise in the next 12 months. and certainly will if we see prices, even if it's a head fake rally. If we see any type of rally, we're going to have a ton of companies coming to market. It's been that way for years. So there's really only a few names that I would look at on in terms of open market purchases, and these aren't recommendations for your listeners, but kind of names that come to mind would be the Kazatoproms of the world, or the Camecos, maybe a Denison, maybe a NextGen. But otherwise, for all other uranium names, even if all the other boxes are checked, good management team, that are incentivized, decent, asset, maybe it's early development stage, maybe they're getting later into permitting, that potentially makes sense at $40 to $45 uranium, exciting catalyst coming up, checks all the boxes. But if you get the sense that they have to raise money at all in the next 12 months, for me, I'd much rather just wait on my hands. I'd reach out to management. I'd get more comfortable with the story. I'd start to build a relationship with them, make sure that they know that you're interested in the upcoming placement. But for me, I just wouldn't buy on the open market for the vast majority of juniors out there. Again, even if you really like the story. So that's kind of my approach. I can say for the moment, we only have one uranium holding in the MJG portfolio at the moment, which is quite low. As of just a few months ago, we had 3, so there's been a little bit of a fluctuation there. The holdings, Denison Mines, again, not a recommendation for your listeners, but reason I like that one primarily is the company's 22.5% stake in the McClain Lake Mill, which I actually had the pleasure of visiting in 2014, which was quite interesting on a site tour with Denison. That's one of the most strategic pieces of infrastructure in Canada, in my opinion, with about a Canadian $1 billion replacement cost if that was to be built again from scratch. Obviously, that's ignoring the years and years and tens of millions of dollars that it would take to re-permit that. But just kind of putting that aside, just rebuilding that from scratch tomorrow is $1 billion proposition. And Denison owns, 22.5% of it. So just on a very, very basic back of the envelope replacement value perspective, that covers almost in the entire market cap of Denison Mines. And then you also got the company's Wheeler River, ISR project that they're pushing along. I view you get the upside there basically for free. I understand that there's certainly technical risk with what they're doing at Wheeler River, and that there's a lot of skepticism amongst the market. I get that. That said, I have had a very recent success with an ISR project that nobody believed in, and people continued to overlook, and that's Excelsior Mining down in Arizona with their ISR copper project at Gunnison. We've held shares there for close to 6 years at this point, and are up 5x on our investment. So I do have some experience betting kind of against ISR skepticism. And then most importantly, the management team there, the amount of intellectual capital from the Athabasca Basin they've been able to accumulate on that team, backed by the Lundin family themselves, which owns 7 to 8% of the company. I just think it's a good recipe for success. When we see this next uranium bull market, whether it's later in 2020 or in late 2023, Denison will be around, and they'll be pretty major beneficiaries. They may not be the absolute, most extreme gainer, may not provide you with the maximum leverage to the space, but by the same token, they'll be around and they'll be able to minimize dilution between now and then much better than the vast majority of uranium juniors out there. So that's kind of our rationale for why that's our pick for the moment. I am looking to add a second uranium position in the near term here. Whether that's on the open market or through private placement remains to be seen.
Very well. Appreciate that information, Matt. And most certainly, aside from Cameco, Denison is without a doubt the best opportunity up in Canada from a developed producer standpoint that could potentially happen within the same cycle.
Certainly, there's as well. Not to jut in. I know you know this space inside and out, but I would say that's an incredible asset, incredibly disruptive asset. I know disruptive is a very cliche word in the business world today, but I truly mean that. I mean, there are plenty of development projects out there globally that maybe would make it into production in the 2030 to 2040 year time frame if it wasn't for NextGen's aero discovery and the insane amount of production that will be coming out of it in the coming years. That said, it's in a very infrastructure poor part of the basin, so there's a long timeline for first production and a lot of hoops that have to be jumped through before the company can get there. And also, I just don't have the same relationship with management there as I do with the Denison guys. There's not that level of comfort, not that level of trust. And I think the Denison guys have been able to run a leaner ship, so to speak, than NextGen. So again, that's a phenomenal asset. That's definitely one that's on the radar, and it's a potential open market purchase. But there are some hairs with that one as well.
Yeah, certainly further out on time frame on that one. I'm not sure what kind of demand for the contracting appetite will be, say post 2025 or beyond that, as far as the lead time and the bottleneck to get that stuff actually in a utility's hands. So just not sure if the time frame matches up with some of the other nearer term demand issues that I suspect will be much more advanced than post 2025. And that is pretty ambitious to have such a project built out and in production by 2025. I think that's even a bit of a pipe dream. But let's move on. Let's talk about precious metals, Matt. Thoughts on the market there? And when I say precious metals, maybe you can give us your thoughts on gold, silver, and platinum, palladium, those four potentially. What do you see coming out there, and what is the area in the precious metals that you really like?
Yeah, so no strong opinion on the PGMs. I've largely stayed away. Again, if it's the right management team with the right asset, if all the boxes are checked, I will take a look. But to me, I'm a bit worried about the demand picture there, just given that 90% of PGM demand comes from catalytic converters, and there's a big question mark there about electric vehicle adoption and how that's going to affect PGM demand in the coming years. So we don't have any PGM exposure at the moment. The bulk of our precious metal exposure comes either through gold or silver. Funny enough, gold is actually my least favorite metal, just from a very personal standpoint. I have a bias towards the metals that help us live our 21st century lifestyle. I like the nickel that's going into our EV batteries, and the rare earth metals that are going into our wind turbines, and the uranium that's going into our nuclear plants and what have you. But again, gold is a metal where I'd say I think close to 50% of the TSXV. The juniors are focused primarily on gold, and I think that number's 35% in the ASX. So 40 to 50% of juniors globally are focused on gold. And so if you're willing to sift through those companies one by one, there are some pretty phenomenal management teams to focus on. But I guess you asked the question more on the macro view. So taking a little bit of a step back, my argument for why gold right now, it's very simple. Maybe it's too simple for some, but I just think the negative interest rate environment that we find ourselves in just can't be overlooked for anybody looking at gold as an investment. I know the numbers have moderated to some degree, but as recently as August, we had literally 30% of investment grade bonds, and that could be either corporate debt, government debt, or securitized loans from consumers. 30% were yielding below negative on a nominal basis, which is just insane to me. Because from my perspective, the very best argument against owning gold, and this has been an argument used by anti-gold bugs for decades now, is that it's a pretty yellow rock that sits in a box and earns no interest. And I actually think in a lot of market environments, that's actually a pretty devastating argument, at least why you shouldn't own physical gold. Why not make a yield with something else? But again, the best argument against gold, at least for the past few decades, has now been flipped on its head, and it's the best argument for gold. Now if your options are negative yielding bonds, where you're basically just taking reward for your risk, to be honest, a pretty piece of rock sitting in a vault, earning you an honest 0% actually is a really good looking proposition in today's day and age. So I just think for that simple reason, the wind is at the sails of gold and gold investors. I think the consolidation period that we've seen over the past 12 weeks or so, 12 to 15 weeks, is actually very positive. I was worried about, I'm hopeful that this gold bull market will last for 3, 5, even up to 10 years. That's on the extreme end. But the fact that we didn't go straight up like we did in 2016, where we had, basically 9 months, 8 months of unabated euphoria, followed by a pretty significant slump. To me, that gold broke that key, 1375 technical level, topped out at 1550, and now it's just been hanging in there quietly, in the 1460, 1470, 1480 range. To me, is a huge positive. And as an investor looking for companies trying to drive value on a company-specific fundamental basis, I am totally okay with this current gold level. To me, it's not that important that we resume our ascent higher tomorrow. I'd be very happy if we can continue to consolidate here for the next 6 to 9 months. So I think things are set up pretty well for gold and silver investors and those with high quality equity exposure. I guess my one word of caution, this is not a contrarian opinion at this point, at least amongst the gold bug community. I do think for the general investment audience, very few people are talking about gold or they're indifferent, so that's a positive. But at least amongst the precious metal investors who have stuck with precious metals through thick and thin, there is a bit of excitement about what's coming in 2020. And I just think things could take a little bit longer to materialize than most gold bugs are anticipating. And again, from my time frame, the way we invest, that's just fine with me.
You bring up a lot of good points. For us, certainly gold is a big part, in my view, a large part of wealth protection. Not necessarily that it pays you anything, but it certainly protects. And that to me is a big key, and is why, we would certainly look at physical metals such as gold and silver. Gold is kind of the cornerstone of that portfolio for wealth protection against things like dilution of currency units, etc. Can you speak to just a little bit about what equities in the space you look at? I know you mentioned earlier there's certainly a focus towards the junior space. Is there any producers, larger or mid-tier producers you look at in the gold and silver space? How are you guys approaching that, as far as maybe if you can share a name or two with us, and where you're mostly focused?
Yeah, so the major producers, that's actually not our focus at all. Throughout basically the entire portfolio. So I have multiple investing biases, and I think it's good to be honest with yourself and kind of understand what those biases are. For me, I'm a sucker for the royalty names. So if I want kind of production exposure to a certain commodity or what have you, the closest we'll generally get is through a royalty and streaming name. And then I also have a bias towards the prospect generator business model. And I think the reason for both of these, and why I like both the prospect generator business model and the royalty business model, is that I've come to the conclusion that the number one enemy of junior mining investors is dilution at the end of the day. And a lot of people say, you need high quality management or this or that. I agree with that 1000%. But I think part of the reason you always look at management first is that the very best management teams are able to minimize dilution, or in some ways avoid it entirely. And the prospect generator and royalty business models are designed specifically to reduce dilution and hopefully eliminate it entirely if things go to plan. So, most of our exposure comes through either prospect generators or royalty names, at least in the gold space. One company I'd highlight that kind of fits the mold. It's one that I've written about for a few years now. Anytime I send out, we send out 2 investor letters per year, one in January and one in July. And for each new investor letter, I will highlight a new featured investment, which is one of the companies in the portfolio that I'm highlighting, both to show current partners of the fund how I'm kind of thinking about things, how I'm making investment decisions, why I like what I do, and then also giving the company a little bit of exposure and getting the name out there. So one of the names I wrote about a couple years ago, and I've been putting out an update every 6 months in every pursuant investor letter, is Golden Valley Mines, company's GZZ, and it's become one of our largest gold holdings and one of the largest holdings in the portfolio at this point. I like quite a few things about the company. I guess just starting with management right off the bat, board and management, they own close to 30% of the company, and they've been net buyers with no selling, to my knowledge, for years at this point. So it's very tightly held by insiders. CEO Glenn Mullen is an honest guy. He's hardworking. He doesn't have a very big name within the industry, at least amongst retail investors, but he already has 2 discoveries to his name. He was a big part of a nickel discovery back around 15 years ago that ended up being taken out by a Chinese group. I think the company was called Nunavut Nickel. And he was also staked and was part of the discovery of what has become the Canadian Malartic mine as well. So he has a good background, he's incentivized, and he's honest, and he's working in his area of core competencies. He's lived in Quebec, and this has been his backyard for his entire life, and Golden Valley Mines is specializing in Quebec. So it's a prospect generator business model. I almost view Golden Valley at this point is more of a royalty play. And the story gets a little bit complicated here. That's because Golden Valley Mines owns 46% of a company called Abitibi Royalties. And that's ticker RZZ. And Abitibi Royalties owns a 3% NSR, so a pretty healthy royalty, over large portions of the Canadian Malartic mine, with cash flows expected to pick up multiple times in the coming years here. So those are incredibly valuable royalties in my mind on a world-class operation, which to my knowledge is the largest gold producer in Canada in terms of any single operation. And so there's good exposure there from a royalty standpoint. The catch is that on paper, these Abitibi royalty shares are worth $80 million Canadian or so, at least when I did the math most recently. And Golden Valley's entire market cap is trading at a fully diluted market cap is 30 to 35% below the value of the Abitibi royalty shares alone. So for me, that's an opportunity to pay 70 cents on the dollar for a high quality junior royalty name with an asset that with royalty assets that I think may be taken over at some point during this cycle. So for me, the investment case is compelling just for that discount alone. But then on top of that, you get a bunch of free exposure to other things that I would consider lottery tickets. Golden Valley Mines also has a 2.5 to 4% sliding NSR over Sirius Resources Chichu project, which is great, and they're getting no value from the market at all. If you buy Golden Valley shares, you get that for free. Golden Valley is also optioned a property to O3 Mining, the newest Cisco Metals gold vehicle. And sure enough, my understanding is that the drills are turning on Golden Valley's Centramock property as we speak. Again, you get that entirely for free. Golden Valley has a 20% free carry on that project, and then that can convert into a 2% NSR. That becomes, comes entirely for free. They also have an active joint venture with Bonterra on one of their properties, where we saw drilling as recently as last year. Again, that comes completely for free. And they then have a huge grassroots portfolio in Quebec, where I think as this mining cycle picks up, we're going to see more and more deal flow. So for me, a company like Golden Valley, it checks a lot of boxes. It's a prospect generator business model. Company hasn't had to raise money for years. No reason to do so in the foreseeable future. It's the right people. They're incentivized. They're honest. They have a long-term perspective. The price to value is very compelling. The company looks undervalued based on the Abitibi royalty shares alone, let alone these 4 or 5 other things that come for free. And they have upcoming catalysts as well with these multiple drill programs that are ongoing on their properties. So that's a name that's a little bit obscure, but checks a lot of boxes and is the kind of company that really appeals to me.
Well, Matt, I appreciate you sharing that information. Some interesting stuff you mentioned, and hopefully the audience were taking notes. Now, on that position, Matt, where are you at in that position? Are you profitable at this point, or are you underwater, or what's the status?
That's a fair question. I think we're averaged in at around 27 cents Canadian, and maybe bought our cheapest shares at around 21 or 22 cents Canadian. So we're well in the money, but this isn't one that we're up 10x on or anything like that. And of course, I just want to throw this out there. That this is not a recommendation for your listeners. Everybody should be doing their own due diligence. Everybody has their own biases. Everybody has their own risk profiles. But this is just kind of an example of a company that I really like highlighting because it fits a lot of the criteria that I look for in a given junior, just between people, business model, structure, value, etc.
Well, Matt, let's move on. Let's talk base metals, final topic. Things like copper, nickel, zinc. Where do you see opportunities in this market, Matt? What's your thoughts? I want you to first start things off by talking about copper.
I think for the industrial metal complex, I think that would include some of the more boring base metals like zinc and lead, and then also some of the more, what I consider energy metals like nickel and cobalt and copper and lithium, what have you. It's been a tough year, largely across the board. Nickel is one exception there, but even over the past 60 days or so, we've seen a lot of excitement fade. It's been frustrating, obviously, as a portfolio manager, for most of our juniors that are focused on one of these, either industrial or energy metals. It's been a down year from a share price perspective. Fortunately, the gold and silver positions in the portfolio have more than carried us for this year. So that's the positive. And I've actually been using this weakness, especially during tax loss selling. So I've been quite busy over the past, 30 days here, 45 days here. I've just been averaging down, in these positions that are existing holdings of ours that we're able to buy at cheaper prices. And so, I'm looking to go into next year with about, 40 to 45% of our portfolio exposed to industrial metals or base metals, energy metals, and then, the other 40 to 45% in gold and silver with kind of some cash and some other investments, in water, agriculture, et cetera, on the side. So I kind of want my foot in both camps. I think the potential for an upside surprise amongst the base metals, whether it's copper or zinc or nickel or cobalt, is actually much higher than it is for gold and silver next year. My sense is that sentiment is very negative, and we've reached what's near peak pessimism at this point. I understand kind of the near-term futures of most of these metals will come down to where the world's kind of economy lands next year. And, there's the Trump-China trade dialogue, which just continues and continues and continues, will play an effect. But, as I mentioned earlier in our discussion, there are signs both from China and the US that we may have another uptick here, at least in the near term. And I think if that's proven out, then a lot of these metals, and particularly some of the juniors that have just been hammered in tax loss selling, could have very explosive years next year in 2020. So I'm not predicting anything. At the end of the day, I'm just trying to buy, again, high quality management teams working on decent assets with good working capital positions and lots of catalysts coming up. So for me, I'm not trying to pick directions of markets per se, but if anything, I think the upside for some of these juniors focused on copper, focused on nickel, focused on zinc even, could surprise a lot of people next year. And I'll leave it at that. But again, similar with the uranium names, you need to be really, really selective if you're looking at juniors in the base metal space. I guess the most, urgent word of cautions I'd give your listeners is, again, just look at that company's working capital position and, look at how much they're spending on a monthly basis and look how many catalysts they'll be able to accomplish before they next have to raise money. And if the company only has 6 months of working capital left and their next big catalyst is a pre-feasibility study later in 2020, well, right there that the company is going to have to raise more money ahead of that economic study. And so to me, it just makes no sense to buy a company like that when you could just wait for the placement and then evaluate it then. But there are certain companies out there, and I'll highlight one we've been buying recently, a Cisco Metals, which is the Cisco Group's base metal vehicle. Their flagships, the Pine Point project up in Northwest Territories, and then they also have significant land positions in the Brunswick Belt, and then very early stage stuff in Quebec as well. They're a company that has virtually unlimited access to capital. They're very cashed up at the moment. I think they have 15 million in the bank. And yeah, their cost of capital is much lower than an average junior with a $60 million market cap. But they're a company that has plenty of cash in the bank and a whole ton of catalysts coming out just in the next 4 to 5 months. They're doing a 5,000 meter exploration program up at Pine Point, where assays will be coming out in Q1 of next year, followed by a PEA at Pine Point in Q2 of next year. They have a drill program that's either starting or has already begun in the Brunswick Belt, where they're looking for zinc and copper mineralization. And then they have none other than Bob Wares, who most recently is off of his Arizona mining success, leading 3 different programs in Quebec. Early stage, they call it Quebec Gen X drilling. They're drilling 3 different prospects, and we're expecting assays, in the next 90 days or so. So here's a company with plenty of cash in the bank, no need to raise for the foreseeable future here. They have at least 5 catalysts that I can count on my hand, 6 actually, coming up over the next 4 to 6 months. And to top it off, Bob Wares has been in the market buying, and over the past 2 years, he's put about 6 to 7 million of his own dollars into the company on the open market at prices higher than the company's trading at right now. So that's the kind of opportunity that gets me excited in the base and energy metal space. Obviously, if zinc jumped, which I think it may next year, I don't think $1 per pound zinc is sustainable given the supply demand dynamics that are the tightness of supply we're seeing behind the scenes. But even without that, there's the potential for major revaluations here, major catalysts that can drive the company's valuation higher before they have to raise money next. And so focus on opportunities like that. And obviously, if base and energy metals surprise to the upside, then great. You'll get an added win as an investor. But I don't like the optionality plays. I don't like betting on a junior purely because I hope the metal price will go up. I'd rather them be able to drive value on the ground. And then if the metal price goes up, that will only amplify your gains as an investor.
Well, certainly a setup worthy of further investigation. And I certainly echo and agree with a lot of your thoughts and views there. And certainly things like copper and zinc for us look fantastic and have a really bright future in my view. And I think it's just a matter of hanging around and keeping some cash and being patient with the market and accumulating where possible. Matt, can you speak just briefly before we wrap up? A couple things here. Can you speak just to your position as far as cash at MJG, what you think is good for having cash around, how much of the fund might be in cash, if you can share that? And then also, how can folks keep in touch with you and MJG Capital?
So on the cash front, we are almost entirely deployed at the moment. And it's a little bit difficult with a limited partnership. It's different. Especially an open-ended one, it's different than your average personal portfolio, where we have cash coming in every month or every other month. So there's constantly more money to deploy. Personally, I think it really comes down to individual investor preferences. The most important thing that cash does is provide you courage as an investor. So you want to hold enough cash where, if we do see, a 30% drop across the board in Q1 of next year amongst all juniors, the good, the bad, and the ugly, they all fall due to global macroeconomic events or what have you. You want to have enough cash there on the sideline where it gives you the confidence to hold your nerve and either maintain your current positions or, if anything, average on and add more. So, that depends on the person. If that's 30% of your portfolio in cash, then great. If it's higher, then great. If you have that conviction and that's at 10%, I don't think it's a terrible time to be close to fully deployed right now. So I'd really leave that to the investor, but I don't think there's an exact prescription that everybody can follow. I think the biggest favor that cash affords is the fact that it gives you courage to hang in there when there's unexpected events that could be entirely unrelated to the fortunes of the companies that you hold. Things can be going absolutely great on the ground, but share prices are affected by many different factors, and you need to have the confidence to hang in there if a share price is unduly factored or affected in the near term by something that's out of the company's control.
How can people get in touch with you, Matt, directly if they have interest in the fund?
Absolutely. I'm always happy to talk over, some of our investments, the fund structure, and just the space in general. Investors can visit the website that you highlighted earlier on the call. That's www.mjgcapital.com. There's a contact form there. And yeah, feel free to reach out if you have questions about any of the companies that I've mentioned on talk here, or if there are any companies that you're looking at closely that you'd like an opinion on. I'm always happy to start a dialogue with your listeners.
Well, very well, Matt. It was really good to chat and catch up, and thanks for coming on the show. Look forward to having you back.
I really enjoyed it, Andrew. We'll talk soon. Appreciate it.